Welcome to the Capital Market and Channels Television. Thank you for joining me. I am Bolaji Akinwale. Today on the program, we will be reviewing the market performance as we saw stable trading by the end of the week. We saw bank earnings trickle in. Zenith Bank and Guaranty Trust Bank posted the full-year results for 2014. Now, both results were judged good by traders and investors alike. And, of course, the impact of the banking sector was quite visible, and also the market in general. We will examine the numbers in the course of the program, and I will be speaking with the head of special project at Carry Assets Management Limited. He is Mr. Ayo Aledari. Also in the program, we will take a look at the regulation of pension fund assets in the country. The regulation, which is at a draft stage, accommodates additional instruments and expands the investable portion of the fund in ordinary shares of public limited liability by 5%. That'll be a report. We'll bring that to you as well. Now let's take a look at the market performance for the week. The equities market expanded week on week for the third consecutive week in a row, signaling stable investor confidence or probably a wait-and-see approach in anticipation of corporate releases. Similar to last week, 4 out of 5 trading sessions closed on a positive note, while a marginal loss was posted on Thursday. However, the benchmark index advanced 3.14% to close at 31,049.37 points, surpassing the 2.54% gain that was recorded last week and came on account of the buoyant gain recorded on Friday. The huge return on Friday, one of the biggest day-on-day this year, came on the back of the 2014 full-year results jointly released by 2 of the top Tier 1 banks, talking about Guaranty Trust Bank and Zenith Bank. Guaranty Trust Bank profit after tax was up by 9.6%, while that of Zenith Bank was up 8.6%. Now, following the releases, investors shifted focus to the financial services sector, most of which gained maximum points after Friday's trading. The week's gain further cut down the year-to-date loss by 300 basis points to 10.41%, representing a significant improvement from the loss of 20.4% as of February 13. Now, in the course of my conversation, we will be discussing the implication of the earnings on other banks, which are yet to release their own results for the year. The market is actually waiting to see how the numbers will look like, and of course how that will lead probably to a positive market performance for the coming week. We'll find out. Now, banks held on to the leading position as shown by the banking index, which recorded 9.79% week-on-week gain, hence taking its year-to-date return to 2.39%. The industrial and consumer goods indices followed with gains of 1.92% week-on-week and 1.89% week-on-week, respectively. You can see that on your television screen. We have the numbers also from oil and gas index that fell by 2%, and we had that for consumer goods up by 1.89%. Accordingly, market breadth remained positive as 40 gainers outweighed 30 losers. A total volume of 2.13 billion shares valued at 24.39 billion naira traded in 22,532 deals. Now, this is against the 2.08 billion shares worth 22.47 billion naira traded in 20,805 deals last week. Now, we saw a volume increase of FBN holding. That's actually topping the volume driver for the week. 533.5 million shares were recorded for FBN holding. For Axis Bank, it was 259.37 million, and UBA 173.6 million now shares. These three stocks actually accounted for 45% of the market volume traded during the week. And meanwhile, we are having for the value drivers, FBN holding topped again, 4.44 billion shares. Nigeria Breweries actually garnered 3.67 billion naira, and we have Zenith Bank pulling 3.02 billion naira. Now, these stocks collectively accounted for 44% of market value transactions during the week. Now, at the bond markets, we're seeing transactions as well. A total of 426 units of FGM bond valued at 440,065 naira was executed in 2 deals. Now, this is compared with a total of 100 units valued at 103,583 naira transacted last week in just 1 deal. Quite a whole lot of figures for you, of course, tracking the market performance, not just the equities market. We had activities as well on the bond market, although it's still been some kind of lull in terms of the secondary markets. We're seeing investors' appetite for equities still a bit here and there, still a bit lopsided somehow. And of course, the concerns and worries out there has made some investors to just sit down on the fence and watch some kind of cautious look at the market figures. Okay, still ahead on the program, we will be taking a look at issues around the pension fund assets, regulation, and of course investment in the equities markets. And later on, we'll be joined by Ayo Alidari, is the head of special duties at Kari Assets Management Limited. We'll be right back. You're welcome back. If you've just joined us, you're watching the Capital Market on Channels Television, broadcasting from Lagos. The amended pension fund assets regulation on investment has been described as laudable by capital market operators in Nigeria. The regulation, which is at a draft stage, accommodates, as I mentioned earlier on, additional instruments and expands the investable portion of the fund in ordinary shares of public limited liability by 5%. Now, the operators believe the improved guideline will help deepen the capital market. Now, Temple Ashajo actually examines issues on the regulation in this report.
Guidelines on how and what to invest pension funds assets in are periodically released in Nigeria by the National Pension Commission, PENCOM. The new regulations, which is yet to be ratified, is consistent with the Pension Reform Act of 2014, and it allows for a 30% investment in equities under the Fund 1 structure of the guidelines. For the broker-dealer community, this structure is commendable.
The review, what they have done, they said they're going to create different fund structures, Fund 1, Fund 2, Fund 3, Fund 4. And each of these different funds will be invested in different areas based on the risk profile of members of this group. So I think for me, that is very excellent. In the whole review, what we have, all the funds were just invested in one instrument. There was no categorization of the age bracket. So for me, that is a major breakthrough. That is good for the pensioners. That's also good for the PFAs and also for the regulators.
If you look at the increase from 25% to 30%, I think it's very good. And this one will even boost the Nigerian capital market. And then we even enable the PFAs to make a lot of money, because when you look at the current prices and when you look at the fundamentals, definitely the fundamentals on the capital market now can support any investment in any of these equities.
Which is a welcome development, because we actually want to see a situation whereby pension fund assets can be invested in the capital market, most especially in the stock market. Because right now, what we have is that we have foreign investors having higher investment than domestic investors in our market. And that is why anytime there's news like this, the market catches cold. And we think that the situation should be reversed in such a way that we are going to have domestic investors having higher share of the market than the foreign investors. So with this new guideline, I believe that if it is implemented fully, we are going to have situation being reversed.
And according to the draft, pension funds can only be invested in shares of companies that have paid dividends in minimum of 1 year of the last 5 years. Operators also seem comfortable with this provision.
I don't think there's any equity on the floor currently that in the last 5 years they've not paid either bonus or dividends. It's just few, and probably in the insurance sector, but I can tell you that majority, about 95%.
According to the pensions regulation, 30% of the fund can be invested in equities. But when the market becomes more vibrant, should these 30% be adjusted?
I think that ceiling should not be cast on stone. There should be a proviso that says in the period that the capital market is doing well, it could be moved to maybe additional 10%. It's about the phrasing of the underlying law that will allow the administrator to make use of it that way.
When market becomes more vibrant, there is nothing stopping the regulators from reviewing the allocation again. Maybe they are going to give equities more percentage. Maybe it's going to even go to 35%. Of course, if the returns are going to justify increasing it, they will. And also, if the markets move otherwise, they can also review it. So it's a function of returns that they are going to get from the market.
With improvements over the old regulations, the new guidelines give room for investments with physical underlying assets, supranational funds, global depository receipts, and non-interest investments that must all be certified by the Securities and Exchange Commission.
For some of the new products, they are put in place that these funds must be invested. Infrastructure, either directly or by bonds. It's a very good, but of course, it has to be guaranteed. If, for example, take Lagos-Ibadan Expressway, they say, okay, that's an infrastructural project, and you want to deploy pension funds. Of course, the federal government has to guarantee it, that at the end of the day, if pension funds were used to finance that project, I don't know, there's going to be a toll, and these monies can be recouped back.
Pension funds are invested with an aim to prevent capital loss. While monitoring will become necessary in this investment development, it will also be important to keep the returns on these investments tax-free. From the Nigerian stock markets, Temple Ashaju, Channels Television News.